Well, good morning. It's February 17th, and you're probably asking, what is Roger doing making a video on President's Day? It's a holiday, for crying out loud, right? Well, I wanted to show you something cool. This is not something that is usually when I do my morning classes or videos, I show you what's coming up for the day or what we could be expecting of what the global markets could be doing and so forth and so forth and so forth. But today, I've got something different for you. Something happened a few weeks ago that really bothered me, and I want to set the record straight. All right? I should have a session called Set the Record Straight. All right. So you see this is Tesla. All right? Do you remember when this happened about, what is it? Let's see, 1, 2, 3, 4, 5, 6, 7, 8, about a week and a half, 2 weeks ago. The stock went up like crazy. Earnings were better than expected. But here was the trouble. If you were to turn on CNBC or read the papers, they would tell you the rationale for this jump, according to Wall Street, was it was a short squeeze. There was too many shares short, and the bulls ran the stock up, and the shorts closed their positions. So I wanted to see if that was really true. So I did some number crunching, and I found out something, and I had no idea Wall Street did it this way, but this is really wrong and not the right way to do it. I got cats meowing in here. If you guys hear cats, that's either cats trying to get in or get out, but we're going to trap them for the next few minutes while this video is going on. So I took a bigger look, and again, everybody was telling me short traders, short traders, short traders. And when I looked at the correct way to calculate short interest or short shares, I found that only 13% of shares were short. The way they were talking, the way the Wall Street pundits were talking, they were talking 40, 30, 40, 50% short. Wasn't the case, but I'll explain to you why. The way Wall Street calculates short interest is they take the dollar value of the shares, the dollar value of the float, all the shares available, and they compare it to the dollar value of short interest. So they take the dollar value and compare it to the dollar value. Long shares versus all shares versus short shares, dollar value. And then they give a ratio. Well, the problem with that is, look at Tesla. Tesla went from $600 to $1,000 in 2 days. The value changed, almost doubled in 2 days. But they were still using the same method of calculating shares. And again, they take the share value multiplied by the float, the amount of shares. So let's say there's 1,000 shares. It's usually millions of shares. But let's say it's 1,000 shares. The stock costs $1. That means that the value would be $1,000. So in this case, the value went from 600 to 1,000 or close to 1,000, and the values became completely distorted. So first of all, that's not the way to calculate short shares. Second of all, don't listen to Wall Street, because this is just another example of how wrong they are and how misinformed they are. Only 13% of Tesla was short. 13%, which is not a lot. It's actually very little. So it was not even close to being a short squeeze. It was just buyers buying the stock. You got wrong information. Now, with that said, I want to show you the right way to calculate short interest. And here's a little screener. And the way you do it is you take all the shares outstanding that are tradable, the float, and you take the short interest and you look at the ratio. So for example, if the float, for example, is 100,000 shares, and if you see that short interest is 10,000 shares, that means 10% of the stock is short. It's that simple. That way, the value, the dollar fluctuations don't play into account. Because, I mean, look at this. How do you calculate using the dollar value of shares when the dollar value of the shares fluctuates and doubles, almost doubles, goes up about 50% overnight? So as you could see here, it's not very accurate. It's not an accurate way of doing things. So again, I created a screener, and I'm going to start giving you this information once a week. Just like I give you the strongest 3 stocks, I'm going to give you the weakest stocks. These are the weakest 20 stocks in the stock market, the entire stock market, that have a market cap, a reasonable market cap. So bigger stocks that are bigger stocks, not tiny stocks, but bigger stocks that have the most short interest. Look at AMAG, 86% short interest. Percentage, float versus short interest compared. All right. GoGo, 72% short interest. Revolve, 79% short interest. Now, this is a list of stocks that has short interest. Now, do you want to short these stocks? Maybe. You may want to wait for a pull-up. You may want to avoid a short squeeze. But the bottom line is, the right way to calculate short interest is not to use the dollar value of the float and the dollar value of short shares. The right way is to calculate the float, the number of shares outstanding that are tradable, the float, and compare it to the shares that are short. It's really an apple to apples comparison, and then price fluctuations won't distort your value. And just for the record, Tesla does not have a high short interest if you do it the right way. It's only about 13%, not 40 or 50. And again, I'll give you this screen every week. You can screenshot it, share it, whatever you need to do. But these are in order of the most shorted stocks, the heaviest shorted stocks, and these are the top 20. Hope that helps. Folks, if you like this video, send me an email. Let me know. I'll post it. I'll read it out loud. support@marketgeeks.com. Post a comment, like this channel. Talk to you soon. Bye, guys. And happy President's Day.